it. So we are just going to start. Sophie, I hope my microphone is clear for you. You can just send a reaction, or you can speak if you want. Okay. So we are clear. Today's topic is going to be very short. Sorry about that. Today's topic is going to be very short, and if you understood equilibrium and discount very well, then you understand equilibrium and premium. Equilibrium and premium is like the opposite of equilibrium and discount. So I'm going to assume we've understood the equilibrium and discount, so that today's work is going to be very, very simple for us, and we close early. Okay. And if you've not gone back to watch equilibrium and discount, please go back to watch it. I said a lot of things. Even when I went back to watch it, I was shocked as to the amount of information I released on that video. So yes, equilibrium and discount today. Let me see. We'll go to GBP USD today. Okay. So I explained equilibrium last week, and then I said equilibrium is the midpoint of price. That is the point where price come to the middle of whatever explosive move it has made. Do you understand? So when we look at, let's assume this is an explosive move in price. It's even great. It's even here already. The candle, sorry, the trading view has put the line already there for me. So let's assume this is our explosive move, the yellow shaded candle, this one. What is happening to the chart? Okay, so let's assume this is our explosive move. Here is the premium. The top is always the premium, and then the bottom is always the what? It's always the discount. So equilibrium is the midpoint. Equilibrium is the point where buyers and sellers agree to keep price at. But that will be the pure how do we call it? The pure definition of equilibrium. That's what economists will tell you. But when it comes to trading, price can fall from equilibrium and go to discount, or can rise from equilibrium and go to premium. You understand? So in a market, in a real market where the system of economics is applied, will tell you that when a price is set, buyers and sellers struggle, or they fight in the market, not physical fights. They fight to bring price to a certain level where everybody agrees to trade at that price. You understand? Except when you go to other places, like when you go to places like Moving Pick, you can get a water bottle for 25 cedis. Water bottle that is sold at 3 cedis outside, you can get it for 25, some of them 30 cedis. Or you can get coconut that is sold for 5 cedi, you can get it 50 cedis at Kempiski, Moving Pick, those places. So when we are looking at equilibrium and premium today, that's today's topic, equilibrium versus premium. We are talking about how sellers can participate in a bearish market. So let's use this move as an example. And then I said in the equilibrium versus discount that to be able to measure equilibrium and discount, or to be able to measure where price will be. Hello. To be able to measure where price will be, price would have to make an explosive move upwards. That's if you are trying to find a discount level to buy the price of the asset you are monitoring at.
Like just to remove something, so it's still the same thing. So nothing.
Let me catch my mind.
No?
I was distracted. Someone is talking here. Okay. Someone wants to join. Ebenezer.
Okay. That's what I'm doing right now. Yeah, I'm doing. So this yeah. So mention your ID. No, I. Okay.
Hello. Um, Sorry about that. Someone was speaking here, and I didn't want the audio to enter our conversation, so I had to wait. Okay. So when we are trying to measure these levels, and I said in the equilibrium versus discount that when you are trying to measure a discount or an equilibrium level, you would have to first look out for an explosive price move. And Ebenezer, you are welcome. You would first have to look out for an explosive price move. So for instance, a move like this, you can see that from here or from here, price went all the way here, all the way to this high. So when we measure this explosive price move, then what do we see? We see a price drop from that how do they call it, that level all the way towards all the way to equilibrium, then drops below equilibrium again. It goes all the way into discount, and then even goes below the 79% level. And at this point is where you get price at the best price you can ever get it. You get the price of the asset you are trading at the best price you can ever get it. You understand? Most times when they fall below 79% level is the best price you can ever get, and sometimes too when it falls below the 79% level is the worst price you can ever get, because sometimes if price is coming down with a force, if it's coming down with and it shows that it's coming down explosively, that means price is likely going to go below the 79% level and go all the way below the 100% level. That means you have a risk of hitting your stop loss.
Yeah.
Understand?
That's what I was.
So over here, this is the daily chart, mind you. So now, equilibrium versus premium. How do we measure premium levels? How do we measure premium levels in order to take sell trades? How do we monitor and say that, okay, the market is trying to go this direction? And mind you, if you listen to the previous session well, you would realize that I said that when price is trying to change direction, it starts with an explosive move. You understand? When it starts with an explosive move like that, it means market makers are trying to are trying to reprice the price of that asset to a new level. You get it? They are trying to change the direction of it. So when you see something like this in price action, when you see something like this is an explosive move. You understand? We will not see this move and now come and say, okay, price is going to be bearish. No, when we see an explosive move in price and it is upwards, that means what? Price is trying to program itself and go higher. It's trying to go higher, not lower. You understand? Nobody will be seeing this big hold move and then we'll start saying, okay, now that it has gotten here, I'm going to start selling. You get it? So when we are looking for equilibrium and discount or equilibrium and premium, we are looking for levels in price where market makers have tried to send price higher or lower. Higher in terms of equilibrium versus discount and lower in terms of equilibrium versus premium. You understand? So look at this move. Look at this move. We can see that, okay, from all the way here, this low to this high, this low to this high, let's assume this place has not happened yet. From here to here, let's assume it has not happened yet. Okay, let's assume all this okay, I'm trying to make adding people. Okay, let's forget about that. So now let's assume this whole move has not happened yet. You understand, right? If you are taking this level from this low to this high, you can see that price fell all the way into the 50% level. You can see that, right? It fell into the 60% level. That's for what? That's for early buyers. Some people don't trust that markets can come all the way to the discount level, so they buy. So let's use this as an example. You go to the market and then you see a car, and then you know that this car is in the range of 30,000 to 35,000. You understand? That will be the equilibrium price. That's the price we have agreed to buy the car. That's the price the whole market agrees to buy the car. That means when you go to other markets in the same country, you can get the price within the range of 30 to 35k. You understand? But you go to this dealer and then the dealer is telling you that we are selling the car at 70,000. You understand? Now you know the price to be 30 to 35k. That's the range of the price. But the dealer is telling you that I'm selling this car for 70k. Then you start bargaining. Then you bargain all the way to, let's say, 35k. 35k, you are not willing to go down again. Why? Because you understand that that's the equilibrium price. That's the equilibrium price. That means you can still buy the car at that point and then what? And not lose a lot of money. You understand? But there are people that go to the market and even though they understand the equilibrium to be 30 to 35k, they still bargain. They bargain all the way for the buyer to send it to 28k or 27k or 26k. You understand? Those are serious bargainers. Those are people who will say, understand price has come all the way to equilibrium, but I'm not going to buy here. I want it at a discount level. So maybe due to other factors, maybe the dealer wants to sell his car fast, he wants to make his money fast, he might agree to sell it at 28 or 27k. That means he has lost what? 2k or 3k profit. You understand? So a conk buyer will be willing to buy this price at this point. Maybe set stop loss here or all the way here. Set take profits here. And then the last session I talked about a symmetrical price swing, where you project the price going, you project the price doing another leg of what it has done. So something like this, from here to here, you copy this and then paste it upwards again, and that will look like this. That'll be a symmetrical price swing. You can see that price came all the way down and then delivered a symmetrical price swing. That means it came all the way to the 100%. but we'll not talk about symmetrical price swing today. You understand? So a punk buyer will be willing to buy at this price, whereas let's just say a buyer, whereas just a buyer will be willing to buy price at where? At the 50% level. You understand? Okay. So now we've dealt with the discount again. We've done another discount. So you can see that immediately price tap into the discount level. What did they do? It started going up. Sorry, the equilibrium level started going up. And that's exactly what we expect to see in price. Is someone trying to join? Okay, Vanessa has joined again. You understand? That's where we expect price to go. We expect to see it rise all the way to the high that it created. And then last time I was saying that when it gets to this high, you don't necessarily have to wait for it to go above this high. That's if you are there's a way they call them something risk takers. Those are people who don't really want to take on big risk. They want their risk to just give them something on top of what they've initially risked. Do you understand? And that's just how some people are wired. But there are people who know that okay, they've studied charts enough, they've done a lot of back testing, and they believe price will go all the way from here to, let's say, this level, and they are willing to wait. Those are different sets of people. But to get the lowest hanging fruit, and then if you are new to trading, or if you've been in the trading space for a while and you've not been profitable for some time now, you should always reach for the lowest hanging fruit. What this does is that it boosts your confidence. You understand? Now you are able to get a certain amount of pips consistently. You understand? So you wait, you hit this high, and then price takes you out. That's a liquidate your position, and then the profit drops into your account. So you do this consistently, you gain confidence. Now you have a higher risk appetite, and you have a higher capital to hold that risk appetite. So what you start doing is that you start leaving price to run. So you can set like 3 orders, leave 1, take profit here, or leave 2, take profits here. When they get triggered, you leave the last one to continue running, and the last one you can allow it to go all the way to where? All the way to symmetrical price swing. And where do we see symmetrical pricing? We see it here at the 100% level. This is where we see symmetrical price swing, and you can see price come all the way to hit the symmetrical price swing. Please, if you don't understand some of the terms I'm using here, right, you can go to the most recent upload, that's yesterday's upload, and watch it again, okay, so that you become familiar with the terms. Or if you don't understand the terms and you can't find them in the previous videos, just make a list of them, and as we go forward, I'll begin to explain certain things more and you understand them more. Okay, so just be patient about that. So now we've dealt with discount again, buy conditions. Now let's look at sell conditions. Let's start from somewhere like this place. You see this whole move downwards. So price has been going upwards. Price has been going upwards. Let me deal with something before we move to the sell conditions. Now, to know whether the price is coming down, right? To know whether the price is going to start coming, because price has to get to a certain point before it starts coming down. So to know something like that, we need a swing low a swing high to form. And when that swing high forms, we start counting the candles. So this is one candle to the left, one candle in the middle, and one candle to the right. And to know whether the price is going to continue falling, we need 4 candles. So this is the swing high, consisting 3 candles, and then the 4th one, we need the 4th one to continue falling. It has to be a rapid fall. You understand? Unfortunately, this candle didn't form. So when looking for something like that, we are either targeting the 3rd or the 4th candle. When the 3rd candle falls with force, when it comes down with a brutal force, like it's determined to go lower, then we can say that okay, we are finding strength in this candle. So what do we need the next candle to do? We need the next candle to continuously fall. But this one didn't continuously fall. It rather retraced and came to, I'm sure when you go to the lower time frame, you'll find another block in this area. It retraced and then continued going lower. So now where do we look for that fall at? We look for it somewhere here. Here too, we see 3 candles, one candle to the left, one candle in the middle, which is the highest one, and then the third candle, which is high also but doesn't exceed the high of this one. That is a swing high. So a swing high is something like this. This candle, this candle, and then this candle. You see, they all don't exceed the highest point, which is the one in the middle. That is a swing high. You understand? So when I start saying swing high from now, you know what I'm saying. And then a swing low is simply like this. This one is low, this one is low, but it doesn't exceed the lowest point, which is the middle one. So something like this. You see this? This is the lowest point, and this one is low. This one is also low, but the low doesn't come all the way and then take out this low. That is a swing low. We can see other examples here. You can see other examples here. This is a low, this is a low, but they don't exceed this low. That's a swing low. This is a high, this is also a high, this is also a high, but they don't exceed the middle point. You understand? That is a swing high. So when we are looking for profit objectives, we try to target the highs and then the lows. You understand? So having spoken about that, we are going to go straight into the equilibrium versus premium. So we are looking for 4 candles. This one, the first one, the second one, the third one, and then we are looking for the fourth one to drop lower. But in a case where it doesn't drop lower, we are looking for the retracement to do that lower drop. You understand? So first drop, second drop, it didn't go lower. Third drop, it didn't go lower. Then the fourth candle, sorry. So 1, 2, 3, 4, 5. Fifth candle didn't go lower, but the sixth candle started going lower. Then we know that, okay, price has started programming to go lower, to fill in the what, to fill in the gap that was produced by the overbuying or the overselling of an asset. I hope I'm not confusing you guys. I hope I'm not confusing you. You can send a reaction. Okay. So let's go back to it. Exactly. So we are looking for a high price, that is 1, 2, 3, and 4. The fourth one should go lower, but if it doesn't go lower, you wait. If it retraces and then you see that this retracement is not showing signs of going all the way up and breaking this high, then you should expect it to also come lower. You are looking for lower prices. That's how you know that, okay, price is going to drop. Then you start anticipating coming all the way down to the equilibrium level or the discount level. So now we've dealt with equilibrium and discount, right? Now we are looking at equilibrium and premium today. And then I said to start looking for, I said in the previous video that to start looking for discount, you have to wait for markets or the market makers to push price higher. Like there has to be an obvious move that, okay, price is trying to go high, like something like this, boom, all the way here. You understand? So now we are looking at something like this. We're looking at something like this. Okay, over here you can see that price has been going higher, but now what has happened here? Please, can someone unmute and speak? I want to see if you are following. I said that in this case we are looking for a premium, a fall in price, and then in last week I said that to know if market makers are trying to send price higher, there has to be an obvious move. That means there has to be something obviously telling you that price is going higher. So a move like this, you understand? Then we know that market makers are trying to program price higher. So what do? We wait for an entry. at either the equilibrium or the discount level. So now if we are trying to find a premium level to sell at, or if you are trying to find equilibrium and premium, that means if you are trying to see whether market makers are trying to push price lower, what do we look out for? And then I highlighted this point, and then I was trying to say, can someone tell me what happened in this point, this particular region in price?
Okay, you could see from selected side that it was going to the seller's direction.
Exactly.
You see that it made one going lower before another long one
Exactly.
kept going before it retraced a little and kept going downwards.
Exactly. So when we are looking for points to sell at, or when we are trying to anticipate a selling bias, what we are doing is that we are waiting for an obvious move in price to show us that, okay, now these people are serious about sending the price lower. You understand? We are not trying to assume that, okay, at this point price will start falling. So you see, price got here, it went up. So we cannot assume until we've seen an obvious move. We have seen that, okay, these people really want to take price lower. And then since over here, since price was going up, it went up from this point to this point, came down small, went up, came down small, went up. At which point do we start saying, okay, now we are trying to hunt sell setups? At which point do we start saying things like that? It's when we see something like this. So you see this move from this top, and this is the daily time frame. So when you see impulsive moves like this on the daily time frame, you can be rest assured that price is trying to go lower, because the daily time frame, it consists of a lot of liquidity. You understand? If we see big moves in the daily time frame, you can know that in this particular move, they spent a lot of money to push price lower. They spent, like, you can really see that, okay, this price going up is big investments. You can see that clearly. Here, from here to here, going up to is big investments, because this is the daily time frame. This is not the 1 minute time frame. In the 1 minute time frame, you can see price go like this, and then it will come all the way down and clear you at the zero level. Why? Because it's the 1 minute time frame. It takes inspiration from the higher time frame. You understand? So we've seen an impulsive move downwards like this, and what we do when we see something like that is we anchor our Fibonacci levels from the top to the down. This time we don't take it from the down to the top, because if you take it from the down to the top, something like this, that means you are trying to find equilibrium and discount, you see, and you will not find price. You see, when price got to this level, 50% and lower, it just continued going lower. So when you are trying to look for points where to sell at, you rather anchor the Fibonacci from the top to the down, not from the down to the top. So you see, upside down, now the 100% level is rather at the top. You anchor it from the top, drag it to the down, and then here you have it. So let's assume this has not happened yet. Okay, I can even use the replay button. Is someone trying to join? Okay, Dennis, question. Please ask your question.
Yeah, my question was,
Yeah.
to go back to can you sound? No, like go back to where you see the Fibonacci.
Okay, here.
Yeah.
Here, right?
Yes, my question. Yeah. So my question is, do you draw it from the wick, on top of the wick, or you can just draw it from anywhere on that line coming down?
You draw it. Yeah, I understand. You draw it from the wick, because the wick shows the levels at where price has gotten to. Do you understand? So you can already see that at some point in time, this body was not just this small body. It went all the way to the top. In other words, at some point in time, this particular candle was a bullish candle, because you can see it went all the way up. You understand? It went all the way up before coming down, then it closed as a bearish candle. You see that, right? Yes. So you draw it from the wick all the way down to the wick. However, there are other markets that don't respond to wick drawings. So what I'm doing for you now is that I'm giving you markets where you can see typical examples so that you know how it looks like typically. But to understand, let's say you don't take interest in trading Bitcoin, or you don't take interest in trading gold, you take interest in trading USD CHF, that's US dollar versus the Swiss franc, you understand? You take these concepts and then you backtest them in the USD CHF, so as to know whether, okay, this strategy that I'm trading is good for trading this particular pair. Do you understand? You don't just say, okay, now I've seen Desmond do it here and then it's going to be the same. Some of the markets, when you anchor it on the fib, it's not going to deliver the same price points to you. That means it might come all the way up, but it might not come all the way to the discount or the premium level. Some also is because of news. It's news induced trading. So you can see a wick like this. You see a wick like this. It's a long wick. So we can already assume that this particular wick was caused by a news event, maybe NFP, FOMC, CPI, one of those huge news events. You understand? So it's going to take a lot of backtesting for you to understand the particular point where you draw from the wick all the way down to the wick. But I can assure you that right now we are in comfortable market conditions, so you can just anchor it on the wick. But for you to gain deeper understanding, I'll advise you to go back and backtest. See, you can be backtesting all day. What backtesting does is that it trains your eyes to look out for what you have to look out for, so that when you see impulsive move in price, you don't get excited, or you don't get emotional and say, okay, this is going to leave me, so I just have to jump into the price. It doesn't work like that. You understand? Just be patient. You backtest a lot, so you train your eyes to know what you are looking out for. So when price is coming back, it's not shaking you, because you know that it's going to come all the way to this point. So I'll be patient and wait for my I'll wait for my entry. You understand? David, Dennis, I hope I answered your question.
Thank you.
You're welcome. Okay, so now we've anchored the fib from the top to the down, and then what can we see price do? So let's do the replay real quick. Start new. No, in fact, let me bring it all the way here. So now we've taken away the other price action, and then we've seen this big impulsive move in price. So we've seen this huge move. Price started coming down from here. So we wouldn't have anchored our fib if this was our current price action, because we cannot tell that, okay, because this alone cannot tell us that market makers are trying to bring price lower. No, we see something like this, then we anchor our fib. But we've seen that price didn't come all the way to our 50 level, so we don't take it as a sell as a sell signal. So we continue going. Price has come all the way, price has brought us all the way down. We anchor it from there to this place. We don't see price come all the way to our 50 or our premium level. We bring it all the way down to still we don't see until this starts happening. Until price starts happening like this. Okay, this was too fast. Let me do this. So let's replay again. Okay, now price came all the way here. This is still too fast, but we can use this. Price came all the way down here, and then when it came down here, what did it start doing? It started pushing upwards. Oh shit, the law students are done with their exams. They are going to be making a lot of noise, but we'll still pull through. So price got all the way here and started pulling up. Then we can now anchor our fib. You understand? Because we cannot leave it here. We cannot leave it here. We cannot leave it here too, because at this point it didn't come all the way to our 50% level. But over here we can see that price started pulling inside this range that it created. Then what happens? You can see this happen. it pulls inside, goes up again, gets into our 50% level. What do early sellers do? Early sellers can place their orders over here. That is, and I explained it earlier, that is the people who are not willing to push the people offering the assets. They are not willing to push them to give them a more premium price. You understand? So in the case of a sell scenario, we use premium because when you have, let's say you have a laptop, you bought it at 10K, right? But you know that if you've used this laptop for a while and you are trying to sell it in the market again, people are not going to buy it at 10K. They will buy it at, let's say, 5K or 6K. You understand? And then you are the one selling this laptop. But you've gone to the market and then you've seen that sorry, I got distracted. You've gone to the market and you've seen that people are willing to pay you 6,000 or 5,000 for that laptop. But you start telling them, you start convincing them that, hey, see, this laptop is not just any ordinary laptop. I know I bought it at 10K and I've used it for a period of time. So you are seeing it as something that is worth 6K or 5K. But you start telling them, I'm not going to sell it at 6K or 5K because I know this laptop. I know what it can produce. I know what it can help you achieve. It's a strong laptop. It has all these RAM. I'm not a deep IT guy, so I can't start mentioning specs, you understand? But I'm sure you understand what I'm saying. It has RAM, it has a cooling system, it's able to process things faster. You can open 18 softwares and be using them at the same time, and the laptop will still work, it will still run. Then you start telling these people things like this, then they start considering, this laptop might actually be a powerful laptop. So let me consider raising my money all the way to 8K. I'm not going to raise it past 8K, you understand? So that is it. These are early buyers. These are people that are not even willing to push more. They say, okay, see, this guy is insisting on buying this laptop at 5K. So let me just sell it at 5K. Okay. But we know that, okay, if we push a little bit more, this person can actually raise their budget from what? From 5K, exceed 6K, go beyond 7K and land at 8K. So what are we going to do? We are going to wait patiently, and while waiting, we are going to convince this person that, see, this laptop is actually worth this 8K that you are coming to pay for it. You understand? It's worth 8K. You start telling them things about the laptop, you start telling them the specs, you start telling them the power it's able to drive. You understand? Then what happens? As you start telling them, you start to wait. Then you wait, then you see that they've raised their budget again. So this is their raising of budgets. Can you see the blue candle? They've raised their budget again. Now they've entered the premium level. That's what I was explaining, that in the context of selling, we use premium and not discounts. In the context of buying, we use discount because if you want to buy something, you want to buy it at the cheapest price possible. You understand? So let's say I'm going to buy a car, and then the seller is willing to sell that car to me at 80K, but all I have is 65K, and then I start convincing the buyer. So in the case of buying, you start telling the buyer the seller the fault of the laptop or the car. So now I've seen that this car it was an accident car and they went to redo it. So it might have some faults that I'll have to deal with later, and then I start talking about things like this. Then the buyer starts, if the seller is not strong-minded, you start considering these things. You understand? True, it's an accident car. Let me just consider reducing the price. You understand? So when you're trying to buy something, you are trying to buy it at the cheapest price possible. That's discount. But in the context of selling, you are trying to sell it at the highest price possible. So you bought it at 10K and people are willing to pay 6K, but you're not willing to take that 6K. You are trying to sell it at the highest price the customer can go to before saying, no, I won't buy this price. I won't buy this thing from you at all. Why? Because you keep raising the price and it's still going to go back to the price you bought it at originally, even though you've used it for a period of time. It has depreciated. You understand? So this price move, it has depreciated. Okay, it has depreciated. But we know that it can come all the way to 50% or premium. it can come all the way to 50% or premium. So what do? We start convincing. This the convincing part that I'm talking to you about is in context of live market conditions, you understand? But in the price chart, we cannot sit down and then be convincing cannot sit down and then be convincing price to start going higher. It's market makers that are programming that, you understand? What we do is we wait. So we start waiting for what? For price to come all the way to 50 or to the premium level. Then we know that when it gets to the premium level, now we know that the sellers are also, sorry, the buyers are also not going to let, yes, the buyers are also not going to let price come all the way to this level. We know that they are going to what? They are going to allow it roam in this level. That's 62 to 79% level, you understand? So we can keep our stop loss here. That's for aggressive risk takers. But we have an understanding through a lot of back testing that price sometimes come all the way to 79 and exceeds a small. So what we can do is we can leave our stop loss here. Or for those who are witty, okay, for those who have a lot of capital, right, to sustain whatever trade they take, they just leave their stop loss here, because sometimes price can come all the way close to this point, understand, take you out and then cut and sell. So what they do is they leave their stop loss here. But today we are not going to be talking about that. We'll talk about stop loss and take profit placements later. Now we've seen that price has come all the way to premium. So what do? We start loading our positions. We load it. And then what do? We anticipate price coming all the way down to where? Down to the price point it got to before retracing into the premium level. You understand? So now let's see what happens. Now let's get rid of this. Now you can see that price entered this level at 62%. It went close to the 70%. Let me remove this so you see what I'm talking about. And let me stretch this. Very clear. Oh, this line wants to very clear. Very clear. It went to the 62% level, rose above it small, and then started coming down. You understand? Now, what happens? And then if you remember the IPDA, that means the 4 frameworks to finding trades in price. If you remember IPDA, I told you something about a reversal. What reversals are is that price goes in the opposite direction that it has already taken, and what most times it does is that it takes out a high. When it takes out a high, then it starts springing down. You understand? So in other words, if you were not confident that price is going to fall from this point, and you see price come all the way to take out this high, because you are expecting lower prices, immediately it takes out this high, then what? You start doing what? You start selling. So you hear people say buy the dip or sell the high. You understand? So instead of you panicking and saying, oh, price is going high, I'm going to wait for it to start going down, no, you can start you can start selling when price is going high. But you don't just jump into the market and sell. It has to have a context behind it. You understand? So now we understand that price takes out the highs and then starts falling. Price takes out the highs and start falling. That's when it is in a bearish scenario or a bearish condition. You get it? So price goes all the way up, goes all the way up, takes out this high, gets into the premium level, and then starts falling. But it reverses, goes up again, and then takes out this high. This is a very good point to buy. In fact, at this point, you can push your stop loss all the way from 100 level to somewhere around 79. Why? Because we have an understanding that immediately price takes out the high or the opposing liquidity, it does not spend much time at where it is. You understand? It starts falling down rapidly. And over here, you can reduce your risk. you can add more positions and then aim for price to get all the way down to what? All the way down to the 0 level. So see what starts, you see, price doesn't come up again. Exactly. Price doesn't come up all the way to take out this high again. You see, it doesn't come up all the way to take, why? Because they're taking out this high already. And the reason why we are confident price will not come all the way to take out this high already.
Heaven in me, everything's changing. I will never be without you. Good morning and happy new week to you. Success to you.
Okay, the sound that was playing has, okay, let me go back to it. Okay, so that's an indication that I've finished 50 minutes. I planned for it to be 50 minutes, but we kind of got into the deeper levels. So yeah, where was I? We are confident price is going to keep falling. Why? Because number one, price has made an impulsive move downwards. Number two, price has retraced. It has not just retraced to the 50% level, it has retraced all the way to what? The 62 to 79% level, and that is what? That is our premium level. You understand? This is what? This is our premium level, 62 to 79. This is our premium level. That's number two. And we are confident it's going to fall again because price moves from opposing liquidity to opposing liquidity. So in other words, it takes out the high in order to what? In order to fall. And because it has taken this high in there, because it has taken out this high in the what? In the premium level, you anticipate a drop in price. So it comes all the way down, takes out this low, and then that's a good 1:5. That means if you risked $100, you are making $500. You understand? That's 1:5.4, so $540. You get it? So let's see where price went to, and we'll do I think 2 or 3 more examples, then we'll end today's session. So let's see where price got to. Price came down. Now it continued going down. You understand? Went all the way close to 100% level, close to 100. Then it retraced. But let's see what happens. Let's see what happens. Let's see what happens. Let's see what happens. Okay. Okay, boom. It has completed a symmetrical price swing. And then I explained symmetrical price, is symmetrical. The spelling is, I'm coming, let me spell it here. So a symmetrical price swing, you see, it has that means from this high to this low, price repasted itself. You understand? So it copied itself from the top here to the down here. So let me show you. Let me show you this. You see, from the top here to the down here, it repasted itself. It copied itself and pasted it again. And then in rare conditions, do we find that price pastes all the way to the 100%? Get it? So if you are looking for a swing trade, if you are looking to be in the market for long, most times you come out at the 27%. If you are hard on meeting your profit objectives, you can come all the way down to 62%. You understand? And sometimes wait for it to go lower. But in rare cases, do we find it come all the way to 100? You understand? And most times before it reaches 100, people get impatient and remove their money. Sometimes it doesn't get all the way to 100 and then starts reversing upwards. You get it now, right? So what did I say? I said that in being in these kind of positions, you look for old lows. If you are in a sell position, you look to exit at old lows. So exit at this low, this first low. Second low is here. You can see that you can exit here. This is a low. Third low is somewhere here. But fortunately for us, that low is at where? It's at the symmetrical price swing. Fortunately for us, that low is at the symmetrical price swing, but we cannot be banking on the fact that price is going to come all the way towards 200% level. So sometimes we leave it here. This is what? This is an order block. You see, this is an order block, and we know price is notorious for what? It's notorious for bouncing or having a reaction around an order block level. So what we can do is we can extend our take profit targets all the way to the tip of this order block. Most times the reaction happens at the 50% level. So sometimes you can extend it all the way here. And then what do we have? We have a 1:10 risk to reward ratio. That means if you risked $100, you are making what? $1,000. If you risked $1,000, you are making $10,000. If you risk $10,000, you are making $100,000. You see, that's how it works. So let's find more examples in price. Let's see. Let me not be mistaken. Okay, the law students are done. Guys, there's going to be some level of noise in the recording, so please forgive me for that. So in the buy condition, now we don't just measure this market swing, we measure all the way here. Why? Because this one didn't come to discount, but in actual fact, this is the whole swing from this point to this point. You see, let me just ignore this. So we don't just measure this point to this point, because this point only gave us equilibrium, but this whole price point was a big swing from here all the way here. You understand? So now what do? We can push it all the way here. Hey, Jesus, this noise. And then when we push it all the way here, what do we get? You can see that price did what? Price did come all the way to the discount level. You see, price did come all the way to the discount level. And then what happened? Let's see what happens. You can see impulsive moves. You see. So if it is truly bullish, when price comes down, if it is truly bullish, listen to this one carefully. Listen to this one well. It will help you in your analysis. If it is truly bullish, when it gets into the discount level, it does not spend much time there. See, you can see the reactions that happen. You can see a lot of wicks here. You can see it came all the way down to the 70% level. You can see wicks. You can see it doesn't spend much time. Look at what happened when it came down again. Boom! Impulsive price moves. Impulsive ones. You can see that it came down to this order block. So you can do a second entry here, but I'll talk about second entries later. That's when we start doing MMXM and MMSM and MMBM. That's market maker buy model and market maker sell model. So you can see this was an entry, it was a buy entry. This is a less risk. You can put your stop loss here, put your take profit here, and this will deliver you 1:5.5. You can see it came all the way to take out this high. You see, so Okay. So you see, in this analysis, in this particular analysis, right? I'm contemplating going outside because the noise over here is increasing. But we'll finish soon, so and forgive me for the noise when you are rewatching. Okay. I'll find a better place next time. So you can see that this one price came all the way to the top, took out the top and started dropping. That's why I say most times we take our exit at the top because we are not certain of what price is going to do later. You understand? Exactly. So here is it. But today we're keen on doing sell scenarios. So look at this. Look at this. Look at this now. Look at this. From here all the way to here. From here all the way to here. We have what? We've seen that price came all the way to discount. Sorry, price came all the way to premium. But when it was dropping, guess what? We can take our take profits below old lows. Below old lows. So see, price came all the way down to this low, took out this low, and then what? On top of other blocks. So this is an other block. See, when price came all the way here, it bounced off of this other block. But this is because price is in what? It's in an underlying bullish bias. If it was a bearish bias, then we can leave it to come all the way down to this level like this. You see, this was a clear bearish bias, and we had an understanding that price can come all the way down to this level. Why? Because we're expecting price to fall all the way down to what? All the way down to a bullish what? Discount level. You understand? So we can extend this one and say, okay, for this particular price swing, we are going to aim for what? For a symmetrical price swing. But when it gets to that symmetrical price swing, oh God, people just stand up and make noise. When it gets all the way to this symmetrical price swing, we cannot now extend price down to this point and say what? Now we are going to take a sell over here and wait for it to come down again. No. This particular swing was fulfilling the buy side interest. You understand? It came to the discount for the buyers to take their entry. You understand? So now in a sell scenario, let's see what can happen. Price didn't come to discount. Price didn't come to equilibrium. Price didn't come. It didn't come. This one, it didn't come to equilibrium. Notice this particular place, it didn't come to equilibrium. So when we extend it over here, people get confused. They'll be like, okay, now look at it. Over here, price was in equilibrium. Yes, it was in equilibrium, but it was not because we extended. It was not. When we extend it to a new swing point, we expect the price to reach equilibrium from that new swing point. In other words, we expect the equilibrium to come. Sorry, we expect the price to enter equilibrium from this level, this particular level, not here, not here. You understand? So it came all the way to the top. Sorry, it came all the way to the down, started going up. It didn't enter equilibrium level.
But she thinks that I'm
Went down again. We pull it all the way down again. And what do we start see happening? It goes down again. We pull it down again. We've still not seen a what? It goes down again. We've still not seen a equilibrium level. Price enter an equilibrium level. Then we start seeing it going up. Going up, going up. Going up. Okay.
Bye-bye. Come on. You think I'm
So yes, starts going up, enters the 50% level.
you said what I did?
Now see, if we had taken our entry at the 62% level, what do? We can exit here, because over here we have an understanding that price was in the initial what buy condition. So even though this one came all the way down, we understand that no, it's still in a bullish condition. You understand? And then the next low that formed is somewhere here, and there's a lot of price action here. I'll talk more about price action occurring at a single point. When you see a lot of price action over here, like something like this, you can see a lot of consolidation here. That means it's going to be hard for price to break below or it's going to have for price to break below this level. You understand? The next low apart from this one is also 5 somewhere here. You understand? And the market was also in a initial bullish condition. So what we do is we can take our profit at this low. You see, at this low. Then what does price do? It springs upwards. So this initial move, this initial move, I'm going to show you something real quick. This initial move, for price to come all the way, you see what I told you. So sometimes it's not advisable to leave your stop loss at the 79% level, because sometimes price comes below it small and then continues going up. So if you leave your stop loss here, you think, okay, price has taken you out, and then it's going to Jesus. What is this? You see, price takes you out and then continues go. So you think it's going to be in a sell condition, but no, it's in a buy condition. You see, we can take our entry and then let's see if this one actually hits the symmetrical price swing. This is 100% level. Okay, let's see if price gets there. $27. Let's see. Okay, they didn't come to 62. It almost got, okay, it actually hit 62. Okay, now it has hit 62 and gone above it. Okay, let's check 100%. Let's see if it will come to 100%. Wait, let's do this now. So we know that, okay, this is 100%, right? But I saw something again and it made me, want to show you more of. So the first example I gave was this, right? This sell condition, right? Now let's look for another sometimes, right, when price is not coming all the way down, when price is not coming all the way to the equilibrium or discount level, and then it keeps going down, what you can do is, wow, it's great I remember this, guys. I'm giving you this good source, this good medicine. You should take this one in. And it's not coming all the way to equilibrium or premium. What you can do is you can ignore the first quarter off, because they are new impulsive price legs. You understand? They are new impulsive moves. You understand? You see, so this one is separate, this one too is separate, but don't forget that the mother of the price move is this one. So in cases where it starts retracing, you should always recognize that it's going to try to come in the price move from this price all the way to this price. If you rewatch it, you understand what I'm saying clearly. but let's focus on this for now. So it didn't come when it was from here to here, it didn't come all the way to equilibrium or premium. So what happened now? Charlie. Yes. So we anchored it from here to here. Boom. It still didn't come. It got close to 50% level. Then what do? We can anchor it from here all the way to the down. Boom. What do you see? Guys, I hope you can see this. Let me see if you can still hear me. Yes, you can still hear me. Yes, you can see that when we anchored it from the top to the down, that is if you want to take an entry without waiting for too long, you can keep following price. Follow the price. See that it came to the premium level, and what happened? It came to the premium level, came all the way to 79% level, and then what? And then it fell. And then it fell down to the initial swing, went to 27, went to 62, but I'm not sure it reached 100. So you see, it's all about finding the initial impulsive move, you understand, or the swing move. It didn't come all the way to 100. You see, that's why sometimes I tell you it's not advisable to wait all the way to 100. You can wait to like 70 and come all the way to 70 and say, okay, this all for me, you understand. So in this particular price move, if you risked $10,000, you'll be making $80,000, understand. And that's Bitcoin for you. Bitcoin gives a lot of pips. So in sell conditions, that's sell conditions that I'm telling you. In sell conditions. Oh, what's happening? In sell conditions. Now let's focus on this one. Let's focus on this one. Look at this impulsive move. All the way down. Boom, 50%. What do we see? We start seeing a price move downwards. These are early sellers. So early sellers, and leave your stop loss here. Price move downwards. You see, what do we look for? We look for lows. So first low is here, second low is here, third low is over here, all the way here. And we can stop here because now we are getting double of what we risked initially. You get it? You can stop here. You don't have to chase all the way to this low. And sometimes price will get there. You just watch it and then not care because you've already booked your profit. Understand? But price didn't get all the way to premium. So let's assume strong sellers didn't sell. So what happens? Price comes all the way here. But we can see it paste new impulsive moves, new swing moves. So what we do is we can reduce it. What do we see over here? Price came near the 50% level, and what happened? It pasted a new what? A new swing move. But let's say that okay, we didn't catch this one because it didn't touch our 50% level. So let's say we do what? We do this instead. This is a new what? A new. But bear in mind, while you are doing this, bear in mind that this is the mother swing low. Sorry, the swing move. You understand? This is the mother swing move. These are just the ones that reside in what? It reside. So the initial swing move will be something like from this to this. But because it's not coming to 50% level for us to take our trade, what we can do is we can keep following. So swing move down, retracement. It doesn't come to our 50% level. Another swing move down. Okay, we can take that swing move down, measure it, put it here, wait for it to hit our 50% level. In this case, it did not hit. But what do? We look at another thing like this. Over here, what happens? Look at what happens. entered our 50, went to our premium level. What do? We sell. You understand? We sell. We aim for this low or this low. We are not so sure of the low over here, but if you go on the higher time frame, I mark this as an order block. So we can just put it at the tip of the order block. And then what does it do? What happens? Price came all the way down. We got a 1:4 risk to reward ratio. And then we end over there. You understand? So let's see if there's another condition. Okay. This is the end for Bitcoin. Now let's go to let's see gold. Let's look at gold. Let us look at gold. Okay, let's go to the 4-hour time frame. No, let's stick to the 1 day and see. So first of all, from this high all the way to this low, you can see that price got to the 50% level and then came down again. And then I was saying initially that what happens when price gets to the 50% level and then you are an aggressive seller. Let's say you're an aggressive seller. Those are people who are willing to sell at the equilibrium level. What you do is you go on the lower time frame, you look for a low. Bear in mind, this is a low first, a low over here. What happens again? This one pasted a new low, so we can target this low. We can say that, okay, if price come all the way to take out this low, we can exit, or we can exit at the tip of this order block. Why do we do this one like this? Is because the market is in what? It's in an underlying bullish condition. You get it? So we can be exiting at points like these. Let me clear this. I didn't want to clear this one because I used to do my weekly analysis. But scratch that. You see? So let's assume we took our entry at the 50 level. There are more things that you can use to take entry, but I'll wait. I'll teach you that later. So we took this one at the 50% level. This one is not even a risk you should be following. If you immediately start seeing that the risk, your chance of getting a return is lesser than what you've risked, don't force it, because it can hit your stop loss, and that means you didn't even stand a chance of making what you even raised in the first place. You understand? So you can push it all the way here, the tip of this order block. You can leave it at the wick or leave it at the body, and then we get a good. That means if we raise $1, we are getting back $1.09. Understand? We didn't even get 90 cents. We just got 9 cents. So let's look at this particular move. Let me bring back these things. Okay, let's go to Euro USD. We are looking for a sell scenario. Okay, this is the monthly time frame, but it's the same. Price is fractal. That means whatever you see on the higher time frame, you see it on the lower time frame. Let's anchor. You see premium level, what happens? Drop down. Let's anchor again. Premium level, this one even pierces above the 79% level, almost gets to the 100. But what do we see? We see a drop down. You see, let's check this one too. Premium level drop down. Let's check this one too. Equilibrium, almost at premium level, and then a drop down. You see, let's check this one. Premium level, but for this market, I don't think it's going to drop down. Why? Because there are other factors involved, right? Price has taken out liquidity here, taking out liquidity here, and then you can see that when it took out liquidity here, when it wanted to take out this liquidity, it was not as impulsive as these candles. Look at these candles; they are huge and heavy. But look at this candle; it's small. So when you start seeing price, it's like price not trying to do much. It doesn't want to force itself. Then you start knowing that something is happening. They are trying to do what? Trying to reprice market. So it took out this low, and then what did they start doing? It starts showing what? Willingness. So look at something like this. Look at something like this. Discount. You see, it starts showing willing. On top of this willingness, we start seeing a consolidation. A what? A reversal over here. Took out this low, and then what? An explosive move upwards. So let's go on the 1 week time frame. Let's see if we find better examples to use. Okay, how about this? It went above the 79% level small, pasted a move downwards, took out this level. Again, you look out for lows. So you take out this low. First, you target this low. Second, target this low. Third, if you are not an aggressive person to want to wait for all the moves to happen, you can leave this one above the or on the tip of the order block. You can see that when it got here, it showed a lot of reaction before breaking below again. You see what happened. So yes, let's see other markets. Let's try GBP USD. Okay, let's see what happened. It didn't get to 50, but what happened here? I said sometimes you can reduce it, but let's look at this first. Let's look at this particular one. You see, go to the 50 level. Let's reduce it and see. See, 50% level, and then a drop down. You see it. How about here? %50 level, equilibrium, and then a drop down. How about here? %50 level, and then a drop down. How about here? %79 level, and then a drop down to take out the low. You understand? So yeah, those are enough examples. So if you are anticipating a bearish drop, please look out for the premium and then the equilibrium level. If you're anticipating a buy surge or a buy push, look out for equilibrium and then a discount level. Okay. Oh, I think my microphone is low, and then I'm also done. So do you guys have any questions? you have any questions? No question. Okay, Nancy, if you please ask your question.
So I just wanted to ask if we are supposed to be expecting these moves every time there's like an all-time high.
Okay. So for the case of all-time highs, right? So like a gold chart, for example, let's use a gold chart. You see, this is an extreme market push. Let's use the daily. It's an extreme market push. So when you see something like this, right? Something like this, you know that market is now overpriced. That means they didn't give the chance for sellers to participate in the move from here to here. You can only see buy candles, you understand? So when you see markets going up all the way like that, what you can do is you can expect price to fall. And then when this fall was happening, it was sharp. Nobody knew about it. It was just falling back. Understand? Nobody expected it. People say, oh, I know someone who told me I never they sell gold, and he was in a buy position, and this one liquidated his account. You understand? So yes, when market is going and is chasing all-time high, is pasting new highs, don't get swayed in the thought that okay, it's going to keep going up. You can chase buy entries and then buy positions, but don't get swayed and think that is all that is going to be happening. You can still measure your move, you can still measure the move, and then expect price to drop all the way towards discount level before rebuying it. That you get it at a clean discount level. Okay, you get it at a clean discount level. Nana Sylvie, please, I hope I answered your question. If you don't get it, please let me know so that I re-talk about it. Did you get it?
Yeah, I get where I
Yes.
shouldn't focus always chasing buys, but we can also expect that the fact that fall back down. That this thing because that right?
Okay, yes, that is exactly what I meant. But then in an all-time high situation, right, you should, and then I'm saying this with certainty, you should that's if you are trading bullish. You see, until you've seen markets give you, because that means that you still hit stop loss at a point, because if you are still chasing buy positions and then the market is coming down, that means you hit a stop loss, right? Yes, but you are waiting for price to give you a clear indication that it's going to go down before you chase it downwards. You can't just see that price is going up, so now you are expecting a sell scenario. In other words, if price got here and then I was expecting a sell scenario and then I sold, that means I'm going to get stopped out, because over here price went up again. You understand? But the fact that it goes up doesn't mean that you should not try and expect a sell condition. You should expect it at some point. Understand? Because that means that sellers didn't get a chance to participate in the market what's pricing. Okay, so any other question? Okay, thank you. Any other question? Okay, if there's no question, then our session has come to an end, and thank you guys for your listening and your listening ears. Thank you very much. Thank you very much. Thank you very much.
Thank you.
Okay. All right. So please, going forward, and then I'll release a weekly market analysis. When I go back to my hostel, I'll try my best to record it in my hostel, because my microphone is low, to record it in my hostel and then upload it so that it aids your analysis in what you should be expecting from Monday to Friday, so that you know how to position yourself in the market and make some money. That is if you are already trading live. But if you are not trading live, just watch it and then look at the thought process behind me analyzing the prices. You get it? Okay, so we'll meet next week again. Bye. Okay.